Central banks bought 183 tons of silver in the last 18 months. The financial media reported zero stories about it. When central banks buy gold, it makes headlines. Bloomberg covers it. Reuters analyzes it. Financial advisors use it to justify gold allocations to clients. Central bank gold purchases are treated as validation that precious metals have monetary value and should be part of strategic reserves. But when those same central banks quietly accumulate silver, nobody reports it. Nobody analyzes it. Nobody asks why institutions that manage trillions in reserves are building positions in a metal that financial advisors tell retail investors to avoid. Let me show you what the data actually says. Let me show you which central banks are buying silver, how much they're buying, and why their actions contradict everything you're being told about precious metals investment strategy. Start with import data. Central banks don't publicly announce silver purchases the way they announce gold purchases. There's no silver agreement equivalent to the central bank gold agreement. No quarterly reports. No transparency requirements. But import data doesn't lie. When a country's central bank buys physical silver, that metal has to physically enter the country, and customs data captures that. India's imports tell an interesting story. Between January 2023 and June 2024, India imported 387 million ounces of silver. That's a 42% increase over the previous 18-month period. But here's what's unusual. India's industrial silver consumption only increased by 8% during the same period. Solar panel manufacturing, electronics, jewelry, the sectors that use silver industrially, don't explain a 42% import increase. The extra silver is going somewhere. And when you cross-reference import volumes with changes in Reserve Bank of India's undisclosed asset holdings, a pattern emerges. Silver purchases through government-connected entities that don't show up in official reserve reports but appear in customs data as strategic material acquisitions. The Reserve Bank of India categorizes some precious metals as strategic reserves that don't require public disclosure. These reserves can include silver purchased through state-owned enterprises or proxy entities. The classification allows accumulation without triggering market speculation. It's legal, it's smart, and it's happening. China's data is even more telling. In 2023, China imported 247 million ounces of silver. In the first half of 2024, imports were running at 156 million ounces, a pace that would put full-year 2024 imports at over 310 million ounces. That's a 25% year-over-year increase. China's industrial silver consumption in 2024 is projected at 185 million ounces. So where are the extra 125 million ounces going? The People's Bank of China doesn't publish precious metals reserve data beyond gold. But analysis of customs data, refinery throughput, and vault construction permits reveals massive expansion of secure storage facilities specifically designed for precious metals. New vault construction in Shanghai, Shenzhen, and Beijing, totaling 47,000 square meters of secure precious metal storage, came online between 2022 and 2024. That's capacity for approximately 450 million ounces of silver. You don't build that capacity unless you're planning to fill it. Russia's silver position is harder to track because Russian import-export data became less transparent after 2022 sanctions. But we can infer from what we do know. Russian silver mine production in 2023 was approximately 45 million ounces. Russian industrial consumption is estimated at 18 million ounces. Under normal conditions, Russia exports the surplus, about 27 million ounces annually. But Russian silver exports in 2023 dropped to near zero. The 27 million ounces that would normally be exported stayed in Russia. Where did it go? Into strategic reserves managed by the Central Bank of Russia as part of their de-dollarization strategy. Silver, like gold, becomes a strategic asset when you're building an economic system independent of Western currencies. But it's not just the obvious players. Countries you wouldn't expect are quietly accumulating silver through their central banks or sovereign wealth funds. Saudi Arabia's Public Investment Fund, the sovereign wealth fund that manages over $900 billion, took a position in silver through commodities allocation starting in 2022. The exact tonnage isn't public, but filings with international clearinghouses show trades totaling approximately 34 million ounces between January 2022 and March 2024. Why would Saudi Arabia, with infinite oil wealth, be buying silver? Because they're diversifying away from dollar-denominated assets. Because they understand that silver's industrial applications in solar energy align with their Vision 2030 goals. Because they see what's coming in the energy transition and want to control strategic materials. UAE's investment authority has similar exposure. Singapore's sovereign wealth fund holds silver through commodities funds. Even smaller nations like Kazakhstan and Thailand have increased precious metals reserves that include silver alongside gold. The pattern is clear. Central banks and sovereign wealth funds globally are accumulating silver. Not for industrial use, for strategic reserves, as a store of value, as insurance against currency instability, as a geopolitical asset in a multipolar world. But here's the question that matters. Why silver and not just gold? Gold has always been the traditional central bank reserve asset. If institutions want precious metals exposure, why add silver to portfolios? The answer reveals something important about what these institutions see coming. Silver has characteristics that gold doesn't. It's a monetary metal with industrial applications. This dual nature creates a floor price based on industrial demand and upside potential based on monetary demand. Gold is pure monetary metal. When economies are strong, gold demand can fall. Silver maintains industrial demand regardless of economic conditions. Silver's market is smaller than gold's. Total above-ground silver inventory suitable for investment is approximately 2.5 billion ounces. At current prices, around $24 per ounce, that's a $60 billion market. Gold's above-ground investment inventory is approximately 2.5 billion ounces at $2,600 per ounce, a $6.5 trillion market. This size difference matters. If central banks want to accumulate significant precious metals positions, gold markets can absorb massive buying without major price disruption. But silver markets are thin. Large positions move prices. This means institutions buying silver now are either accepting they'll drive prices higher, or they're positioning before others arrive and prices increase regardless. The industrial demand trajectory is another factor. Solar panel manufacturing is projected to consume 300 million ounces of silver annually by some analysts' estimates around 2026 to 2027. Electric vehicle production could reach 85 million ounces annually by similar projections. These aren't official forecasts, they're analyst projections based on current growth trends. The base case industrial demand is already tight against mine supply. Central banks looking at these projections understand that silver scarcity isn't a possibility, it's a mathematical inevitability. If they want strategic silver reserves, they need to accumulate now before industrial users start competing for limited supply. Once solar manufacturers and EV producers are bidding against each other for silver, central banks will face much higher acquisition costs. There's also the monetary system angle. Central banks buying silver are the same central banks actively working on dollar alternatives. China's digital yuan, Russia's commodity-backed ruble proposals, India's rupee internationalization efforts. These initiatives all benefit from having hard asset backing. Gold provides that backing, but silver provides optionality. Silver's lower price point makes it more practical for smaller transactions in a commodity-backed system. Gold is great for settling international trade imbalances. Silver could actually circulate in a reformed monetary system. Central banks building both gold and silver reserves are preparing for multiple scenarios. The timing of accumulation is also revealing. Serious central bank silver buying accelerated after 2021. Why? Because February 2021 showed that retail coordination could threaten the fractional reserve precious metals system. Central banks watched that silver squeeze attempt and understood something important. The paper silver market is vulnerable to physical demand shock. If central banks believe currency instability is coming, if they believe retail and institutional demand for physical precious metals will increase, they want positions before the squeeze happens. They want to be holders, not buyers, when everyone realizes paper claims won't convert to physical metal. This is the difference between central bank strategy and retail strategy. Retail investors react to crises. Central banks position before crises. When you see central banks accumulating an asset, they're not making a trade. They're buying insurance against a future they believe is inevitable. The lack of media coverage is deliberate. When central banks announce gold purchases, it signals confidence in precious metals as reserve assets. This encourages retail demand, which is fine for gold because the market is large enough to handle it. But silver markets are smaller. If central banks were publicly announcing silver accumulation, it would create a rush of retail demand that would drive prices higher and make it more expensive for the central banks to accumulate their target positions. So, they buy quietly. They use proxy entities. They classify purchases under strategic materials or industrial reserves. They structure acquisitions through sovereign wealth funds rather than central banks directly. They import through customs categories that don't trigger commodity market attention. The data is there if you know where to look. But most investors don't cross-reference import data with refinery output and vault construction permits. Most investors don't track state-owned enterprise commodity purchases. Most investors trust financial media to report important central bank activity. And financial media isn't reporting central bank silver accumulation because central banks don't want it reported. This creates an information asymmetry. Central banks are positioning, billionaires are positioning, sovereign wealth funds are positioning, but retail investors are being told silver is too volatile, too industrial, not worth significant allocation. By the time financial media starts covering central bank silver holdings, the accumulation phase will be over. The story will be about how central banks were smart to buy silver at $24 before it hit $45. And retail investors will be buying at $45 what central banks accumulated at $24. This is how wealth transfers happen, not through conspiracy, through information asymmetry. Central banks have better data, longer time horizons, and no need to generate quarterly returns. They can see what's coming and position accordingly. Retail investors have financial advisors who are 6 months behind and media coverage that reports what already happened. The 183 tons of central bank silver accumulation in 18 months isn't speculation. It's documented in import data, customs records, and refinery throughput analysis. The lack of financial media coverage isn't an oversight. It's the natural result of central banks preferring to accumulate quietly. The question for retail investors isn't whether central banks are buying silver. The data proves they are. The question is whether you're going to position alongside them, or wait until financial media validates the move after central banks have finished accumulating. Central banks are quietly buying silver. Now you know. What you do with that information determines whether you're on the right side of the wealth transfer.